Now, the outbreak of COVID-19 pandemic is unambiguously the worst health and economic crisis in the last 100 years during peacetime, with unprecedented negative consequences for output, jobs, and well-being. It has dented the existing world order, global value chains, labor and capital movements across the globe, and needless to say, the socio-economic conditions of large sections of the world population. The COVID-19 pandemic perhaps represents so far the biggest test of robustness and resilience of our economic and financial system. In the extraordinary circumstances that we face today, history could provide us with some useful guidance in respect of the role of central banks. Guided by the age-old wisdom summarized in Bajort's dictum that ascribes the role of the lender of the last resort to the central bank, the Reserve Bank of India has taken a number of important historic measures to protect our financial system and support the real economy in the current crisis. The liquidity measures announced by the RBI since February 2020 aggregate to about rupees 9.57 lakh crore, which is equivalent to 4.7% of 2019-20 nominal GDP. So about 4.7% of the GDP. That is the kind of liquidity measures which we have announced from February this year. As a fulcrum of the calibrated supervisory approach, the Reserve Bank has strengthened its off-site surveillance mechanism. Now, this is very important. Internally, we have, based on technology, thanks to the CRILIC system and the other technology tools that we have at our disposal, we have strengthened our internal off-site surveillance mechanism to identify emerging risks and assess the vulnerabilities across the supervised entities for timely action. We are also working towards strengthening the supervisory market intelligence capabilities of Reserve Bank with the help of both personal and technological intelligence. Specialized handling of weak institutions at the Reserve Bank now helps in closure monitoring and successful resolution of such entities in a non-disruptive manner. The timely and successful resolution of the Yes Bank is an example. After exhausting all other possible options, and with a view to safeguard the interest of depositors and ensure stability of the financial system, we decided to intervene at an appropriate time when the net worth of the bank, that is Yes Bank, was still positive. The Yes Bank reconstruction scheme forged a unique public-private partnership between leading financial entities of India, and it was implemented in very quick time, which helped the bank's revival, successfully safeguarded the interest of the depositors, and ensured financial stability. I wish to, at this point of time, compliment the State Bank of India for providing leadership to this initiative. With regard to the Punjab and Maharashtra Cooperative Bank, the Reserve Bank is engaged with all stakeholders to find a workable solution, as losses are very high, eroding deposits by more than 50%. While multi-pronged approach adopted by the Reserve Bank has provided a cushion from the immediate impact of the pandemic on banks, the medium-term outlook is uncertain and depends on COVID-19 curve. Policy action for the medium term would require a careful assessment, and this is very important. Policy action for medium term would require a careful assessment of how the crisis unfolds. Building buffers and raising capital, I repeat, building buffers and raising capital will be very crucial, not only to ensure credit flow, but also to build resilience in the financial system. The economic impact of the pandemic due to lockdown and anticipated post-lockdown compression in economic growth may result in higher non-performing assets and capital erosion of the banks. A recapitalization plan for public sector banks and private sector banks has therefore become absolutely necessary. While NBFC sector as a whole may still look resilient, the redemption pressure on NBFCs and mutual funds also need close monitoring. Increasing share of bank lending to NBFCs and the continuing crunch in market-based financing faced by NBFCs and HFCs also needs to be watched very carefully. Now, despite substantial impact of the pandemic in our daily lives, the financial system of the country, including all payment systems and financial markets, are functioning without any hindrance. The Indian economy has started showing signs of getting back to normalcy in response to the staggered easing of restrictions. It is, however, still uncertain when the supply chains will be restored fully, how long will it take for demand conditions to normalize, and what kind of durable effects the pandemic will leave behind on our potential growth. Targeted and comprehensive reform measures already announced by the government should help in supporting the country's potential growth. Possibly in a vastly different post-COVID environment, reallocation of factors of production within the economy and innovative ways of expanding economic activity could lead to some rebalancing and emergence of new growth drivers. The policy measures, that is monetary, fiscal, regulatory and structural reforms, provide the enabling conditions for a speedier recovery in the economic activity while minimizing the near-term disruptions. The need of the hour is to restore confidence, preserve financial stability, revive growth and recover stronger.